Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And we're all on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you guys buy it. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Good morning, everybody. My camera is not working. Oh no. Hold on. I'm gonna fix it. I know what to do. There we go. All right, guys. It is Thursday. We're gonna have some news coming out here in a little bit. I got all sorts of stuff going on. I have just not been very organized this morning. I don't know what the deal is. But hey, the jobless claims, I think that this could be a significant number. So let's just be real quick here. Go and look at the charts. S&P 500 kind of taken off after the FOMC meeting, but now in the overnight, the Swiss the central bank decided to raise interest rates too. Shocking, I know. Central banks raising rates? What? But that's what happened. And so the markets took a pretty big tumble off of all that. Hold on, let me start my news clock here. Oh, it's right here. Okay. And then you can see here in the treasuries, right back down to lows, although it kind of seems like there's a little bit of a bid here. So it seems like there are some people that are saying 3.5. There are some people that are saying 3.4. But then there are other people that are saying that the Federal Reserve will have to back off well before they ever get to that point. So we'll see. Oil taking a dive yesterday. And a little bit of a decline overnight as well on concerns about economic growth. So, well, I guess that's good, but anywhere above 100 is a high in oil still. So, right, we get below 100, then maybe things ease. That would be good, right? Gold and silver also taking the hits. Ooh. And copper. Ooh. Okay, so everything is kind of screaming to me stagflation at the moment. Be afraid, etc., etc. Bitcoin taking a little bit of a jump off of the thing as well and coming back to 2100. Yeah, Bitcoin just looks primed for a washout. And then we got the dollar. The dollar, well, it's been all over the place, but it's becoming weaker at the moment.
Bottom of the hour. Housing starts forecast.
So we do got some numbers coming out here.
Building permits forecast to pare back to 1.7.
Make sure I got everything set up right here.
Jobless claims seen at 215.
See myself taking a trade immediately off of the news. So pretty light here in the micro treasuries. So
Philly Fed, which sometimes hits a little bit early, expected to rise ever so slightly to 5.5 from 2.6.
Oh, we get Philly Fed today too, huh? So the expected number is 5. But the initial jobless claims, they're looking for a reading of 216.5. So we shall see. We shall see. How are we doing? And did we put everything? We got the public. Okay, cool. Everything on the stream set up right here.
Ten seconds to the bottom of the hour. So for housing starts 1.549 million and prior revised up. Analysts were expecting 1.7.
Okay, initial jobless claims 229,000 versus an expected 216, so it is higher than expected.
5 claims 229,000 against a prior revised 200.
So I would say 10,000 above expectation is enough to have an adverse, not like a huge reaction. But that's probably going to move the treasuries up. They are above 115 even now.
To 1.302. Meanwhile, Philly Fed negative
that.
3.3.
Now we got the
That is
Philly
miss
Fed.
on
Ooh,
the headline
Philly
there.
Fed negative
The
3.3
6-month
versus
index at
5.
-6.8, and that falls from 2.5.
That is a buy.
CapEx
If I ever saw one.
rises to 11.7 from
Not saying that the data really justifies a strong buy, but the
28.1
treasuries,
from 25.5.
they bought up
Prices
on that pretty
falls
hard.
to 64.5 from 78.9. So the prices paid sub-index 64.5 in June.
FX Macro tweets, I hope the Fed is data dependent because the data is awful. Oh, I'm retweeting that one. Retweet. Oh man, that was hilarious, dude. Oh jeez. Wow, Tether burns another 800 million of Tether last night.
Wage growth is contained so far. So just going back to these data that we just saw from the US, starting off with initial jobless claims data, the prior was revised up to 232. We were expecting 215 this week, but we'd get 229. So we fall ever so slightly, but continuing claims rises to 1.312 million from a revised 1.309. For the building permits and housing starts miss expectations.
So there was a big bid there for a moment at 115.02 half.
1.701.
But they like immediately got filled.
5 million. And that is again towards the bottom end of the range. Analysts were looking for 1.785 there. That Philly Fed data is not great at all for June. And again, we got that Empire Fed survey earlier in the week that did fall short of expectations. This, in fact, goes the other way. So we actually see a decline to 3.3 for the headline against an expected rise to 5.5. And it looks like a lot of these sub-indices also fall 6-month negative 6.8 from 2.5 positive. CapEx does pick up, but 11.7 from 9.6. Employment picks up to 28.1 from 25.5. The prices paid index falls 64.5 from 78.9, while new orders, the forward-looking metric, collapses to negative 12.4 from a positive 22.1 prior.
Okay, so they kind of backed off a little bit there. They extended a little bit further, but there was a liquidity hole there at that location that I had identified where there was a large, an unusual large transaction there. Well, I'm not 100% sure what to do with this now because, of course, all of the central bank stuff is aggressive. It seems to me like, 3.4, it's hard for the treasuries to stay above 3.4 though, right? Like I'm thinking we should be at 3.5. But then anytime that they get above 3.4, something happens and they can't hold it. It's not like they don't want to get there per se. It's just like they just can't hold it. I wouldn't mind picking off that order right there at 3.412. There you go. And maybe even 408. Like, look at that. You could take 2. Yep, he did it. Okay. He did it. And then you could have both of your lots sitting there at 3.4, 3.401. Right? I wonder, hey, maybe it's a retail trader did that. Because look, there's 2 lots there. But then the robot's going to have to do it. And the robot's not going to do it unless this really pushes here, right? Not a good slate of USD. I mean, the longer term trend I think is still higher rates, but this data is bad. So I don't know if this is like we just get a temporary trend here, or if this is like it's going to go all day. Because if it's going to at this point, one has to wonder, coming back here to the treasuries, if this is not like peak hawkishness. If from here on out, it's the economy is sucking and they can't really raise rates anymore, or they don't need to raise rates anymore. You know what I mean? I mean, it's kind of giving me that look. Now here at 115.050, we are getting into bull territory, so how are we doing over here on the stream, by the way? Do I have everything set up
More here
correct?
from the ECB's Visco.
I
He
think
says
we
the
do.
ECB is capable
I think it's just a slow start
of
this
sterilizing
morning.
liquidity without
But I
selling
see there's a couple of you on here,
securities.
so I
ECB's
think I have the
Visco,
stream set
we
up
are
correctly.
capable of sterilizing liquidity without selling securities. Remember that sources report, they were talking about offsetting some of the bond buying. But ECB's Visco over here just talking about how they're capable of sterilizing liquidity without selling securities. I'm not sure if he's strictly talking about that fragmentation tool. Worth keeping that in mind. And meanwhile, the CEO of Gazprom just confirming what earlier reporting has really intimated. Gazprom is cutting gas supplies to Europe.
Well,
And more on the energy front here. Energy Secretary Granholm expected to meet with refining executives 23rd June.
I don't know if this is a new headline, but the CEO of Gazprom says Gazprom is cutting gas supplies to Europe.
The majors last
So
week.
I don't know if that is an
Secretary Granholm
unexpected.
expected
Oh,
to
why do I
meet
have
with
that on?
refining-
Let's turn that off. Sorry. I don't know if that's like known news, if that's a market mover or what, but I don't see oil taking off from that. Maybe that's a buy in oil. I don't know. That's a little odd. It's a little odd. Seeing gold is really like as the treasuries are moving up here, gold is pushing really hard too with it. There is all sorts of stuff going on right now here, guys. So I am seeing a good amount of chatter about fragmentation in Europe and the guys over in Europe are talking. So I don't know if that is affecting the treasuries here or not. I have to say that decline that we just saw here was a little steep. So man, I guess we get to keep in mind that there was a bit of a reversal before all this. Somebody must have been front running that news. But you can see why I'm a little bit weary to try and take a trade here in this. Oh man, and look at all those current trades here in the middle. So somebody took out all of the inside liquidity in the micros. Looks like they were all sells. So someone feels confident. Well, O2O is still kind of like that volume node, so that's not necessarily a place that I want to take a trade. Could be a good location for like build a base and then go for a high long or later, or for a reversal, but I'm not 100% sure what it's going to be. This is really, I don't know. Uh, okay, now I'm seeing oil start to move a bit. I don't think that all of the news squawks picked up on that particular headline. At least not immediately. Hmm. I don't know. I'm not 100% sure what to make of this. It seems like there's pretty strong flows on both sides of the market here, and the liquidity is relatively thin. I mean, I don't think that I should make too much of it being below 1,000 at the moment. You know, we did have some news that is moving around a lot. So it's kind of like we were saying earlier, like we should expect liquidity to be a little bit light, but it's definitely affecting the action. It's quite easy for them to move. And you can see that they're only trading like 100 lots to move it too. So hey, good morning, John. I've been listening to News Squawk this week, and because they gave me a demo for a while, and he was talking about the weather. They're saying that they expect above average temperatures for New England. I'm not 100% sure why they're talking about that on the fixed income stream. I suppose maybe because it will have some impact on like gas prices, but last thing you want, you're having an inflation crisis, and then you end up having a summertime energy crisis, that could be not so good. Well, I am not going to take a trade when the spread is 10 ticks. No, sir. I suppose I could put some limit orders out. I've noticed that sometimes we can kind of get them to bring it in a little bit. Yeah. See? Somebody else is doing it too. Like, I see what you're doing here, Seth. Let's bring it in, boys. Let's bring it in. Market is a little crazy. But we can bring those spreads in. It doesn't need to be 10. It could be 5. The spread could be 5. My order does appear to be affecting it, right? Maybe everyone is worn out from yesterday's, probably. I mean, the whole rest of the week. Well, you know what I find is really interesting about this particular situation is that we had a Federal Reserve meeting yesterday. There was all sorts of chaos around it. In the end, the market decided to buy off of all of this, right? Which in my opinion, it was a little okay. Like, here's the thing that bothers me is that Powell is all saying, "Oh, I don't see any signs of a slowdown here." Really? Because like we keep getting like manufacturing index prints that are negative and unemployment claims are picking up. Like, are you kidding me? You're not paying attention because the data is not good. It has not been good for the past month or so. Powell says everything's fine. Okay, well, so that all goes through, and I'm all a little skeptical about it. Then the central bank of Swiss, it's the SNK. I don't know what that stands for. Okay, but the Swiss National something. Okay, they come out and they raise rates, and their impact on the market just dwarfs what the Federal Reserve did yesterday. Like, what? That's kind of weird. So now, like, anybody that bought yesterday is kind of underwater, right? So it's kind of an interesting situation. It's one in which I think that you could see a turnaround and the S&P 500 get a little ugly today, except for that a lot, they've already moved so much overnight. So if they were going to move down in ES and NQ, right, you're talking about another one of those like 4% days because they're already down like 2% overnight, right? So would the market makers be worn out? Yeah. You'd have to think that they'd be worn out, right? The issue in the 10-year is there's just not enough liquidity out there, and the retail traders don't know what the okay. I think these are more headlines from Europe hitting us here. Okay, they brought it in a little bit. That's a little bit better. It's one person holding it there. I don't know if I want to be the one holding it there at 3.424. Yeah, and Christopher Garcia posts a bunch of bears. You know, I have a if you're well, I guess you have to be a channel subscriber for $1, and then you can use our special rainbow bear emoji. Like, so I just keep hearing these headlines. We're concerned about fragmentation. We're not concerned about fragmentation. And these quick little moves in the treasury. So I don't know if they're related or not. Very illiquid market though. Yeah, I really don't like it. The I think there's reasons to buy and sell, and I'm not quite sure which flow is more dominant here. The moment it seems that the selling flows are more dominant, especially in the 5-year. I don't know. Maybe we should be buying the 5 and selling the 10, except for that the spread on the 5 is ridiculous. Look at how inverted it is. Oh geez. Didn't even realize. Like the 10-year is at 3.43 and the 5-year is at 3.543. So they're already inverted like 10 basis points now. Maybe for spreads, we should just use these instead of the treasuries. See if you can move the market. I could, but I'm not gonna say that I could like quote unquote move the market, but it would react to my orders. You know, like if I came in here and I picked off this guy at 3.424, it would probably react, would probably tick down or something like that. But I'm not confident enough in a direction to be playing games like that. So like when we think about flows, it is Thursday, so you do tend to get decent movement on Thursdays. It's a day after a Federal Reserve meeting, so there's going to be flows trying to trade off of that. And there's just going to be general overall sentiment that central banks are tightening. So you're going to see that kind of flow. But then all of the economic data that we just got was pretty bad, and would suggest buying the treasuries here. So those two flows kind of conflict, right? Which one is going to win out? I'm not really sure. It doesn't really make sense for me to try and pick the winner in that situation, because what do I know that is gonna give me an advantage in knowing which side is going to win, right? So all I can say is there's flows both ways and extreme flattening in the yield curve, right? And other than that, I think that I just kind of have to sit here and let them work it out and see which way they go. I kind of suspect that they might push a little bit higher, but let's see. So this is an interesting headline. Microsoft is rolling out a new app for corporate sales reps that aims to get Salesforce clients to pay for a product that connects Office and Teams data to their customer software. Are they suggesting that you would be able to contact your sales reps in other companies through Microsoft Teams? That would be interesting. What do you think, that the market will go up or crash? I don't know. So at the moment in the treasury, we're getting a little bit of downtrend, right? I suspect that there might be another flow that will come in a little bit later, like maybe 15 minutes from now, that will come in and push us up, right? I'm not necessarily looking to participate with that move because, again, there is a selling flow, right? And a bit of a back and forth going on here. So I don't know which side is going to win. In this situation, I don't know which flow is going to be stronger. So it's probably best for me to just kind of sit back and watch it and, gauge which flow is stronger. And then maybe we could take a trade sometime after the S&P 500 opens up. Feeling a little dehydrated today. I just really mouth a little dry and stuff. So you're getting some significant selling in the treasuries here, right? That's enough there, reaching 37.16 to put us into, downtrend territory based on the average true range. Now, that could be if we're still if today is like an uptrend day, then this is exactly where it's going to turn around, right? So you go and you take out the ATR stop, and then you flip around. That's what they like to do. Yes, just a reminder, Monday is Juneteenth, and there will be no trading that day. And I guess I will be taking that day off to do some programming, probably. I guess there's some writing that I need to do too. I know there's some programming that I want to do, but I keep putting it off and doing the writing for videos. How about 6 months later? My feeling at the current time is, well, okay, so that just gave me a thought about something else that I've been seeing in the market that I find a little perplexing. So Goldman Sachs, for instance, said that if the Federal Reserve raises 75 basis points, that's probably going to be enough to set the economy on the path for a recession, right? And then there was like these surveys about, what economists think and everything. And they're basically projecting that by 2024, we'll be in a recession. Okay, but that's like 2 years from now, right? Like, we could be in a recession right now. So are they saying that we're going to be in a recession for 2 years? Because that is no longer a recession, my friends. Right? If that's what it's going to be like, that's no longer a recession, right? So from my perspective, I see economic weakness. How much of that is already priced into the market, and how long does that last? I'm not sure, because I'm kind of seeing a couple of things here that kind of seem off about that. Like, if I think that the S&P 500 is going to be lower 6 months from now, then how can interest rates justify continuing to rise, right? Because 6 months from now, it's going to be, oh yeah, we're not getting the inflation anymore. We can back off, right? So I don't think that I can make a prediction for 6 months from now. I think that there's a really good chance that after the beginning of next week, there is kind of a scenario for, with the way that the options are positioned, that we could see a little bit of buying here. Okay, because not only are the options positively skewed, but there is a lot of funds out there that have money they need to allocate. So we could see some buying from that in the equity markets. But then after that, fine, I'll download and install it, Evernote. After that, then where is the economy going from there, right? So maybe 2 weeks from now, we could see the S&P 500 lower than 3,700, right? Yeah, as of the current time, today in the S&P 500, I think that we're likely to see an opening drive push below 3,700, a little bit of chaos after they cross 3,700 that eventually peters out and then rises back above. Is probably what I think we'll see in the ES. That's just based on the options. Based on the options and the sentiment that we seem to be seeing in the yeah. Lost my train of thought there, but I think you get the point, right? So that's where it's like, well, if that's what we think, wouldn't we want to buy the treasuries here, right? It's a little early for it, but we did get a pretty decent buy spike there, right? Soon you're gonna buy Ethereum? Let's see. Having so here's another interesting situation that we might see, okay? And this would be one that would be bad for Bitcoin, right? Is that we could see a situation where the economic data continues to be weak, but the headline inflation data continues to be strong, right? That is a very real possibility, especially if the weakness is just kind of only slightly. Because like what we're seeing right now, it's not like alarming to me, but it's just, yeah, it's down. It's not good data, right? It's just, and it's not like the individual readings are extremely negative like it was during COVID. It's just like everything is kind of a little bit negative, which is concerning to me, right? In that situation, you have a poor economy, but the Federal Reserve is still keeping rates relatively high and everything. That's not going to be good for Bitcoin. I don't know. Like in cryptocurrencies, here's my take on the cryptocurrencies, okay? Well, first of all, my own bias here is that at this point, I just absolutely despise cryptocurrencies. And I don't care if a bull run starts today that's 100x. I don't want to be involved in it. I don't. I think that when you go to Celsius, oh my gosh, people were posting a lot of these threads on the Buttcoin subreddit. But basically, at Celsius, they canceled withdrawals. You can't take your money out or anything. And there's questions around its solvency and if the fund is going to survive or what the deal is, right? And like, honestly, it kind of makes you wonder what these organizations are thinking, especially with kind of when things come to a point like they have in Celsius where everybody wants out and they close redemptions, right? What do they think is going to happen? Because if I had my money in there, I'm taking it out the first chance I get, So how do you recover from that? I don't think that preventing people from taking their money out helps you recover from that. There's all these people that just desperately want out. And so like on all of their tweets and stuff, there's all of these people like begging, like my whole life's savings is in there. I need that money, etc., etc. Like, what? Are you kidding me? I can't believe that people would put that kind of money that they really needed in these cryptocurrency, basically scams, right? This is where the government organizations need to come in and do their job, because this is what they're there to protect people from, is predatory companies tricking them into putting their money into something speculative and losing their life's savings off of it. Right? So I'm really against cryptocurrencies because of that. And so when I look at cryptos, I do see that we are to a point where they've kind of had a tendency to bounce in the past. Okay? Like at this valuation is about where we bounced last time. Now, is that particular data point that significant? I'm not so sure. I don't think that the market necessarily reacts to it. I think that it's kind of more of that just kind of tends to be the tendency based on how much activity has to be on the blockchain compared to what the current price is, right? I think that the reason that it took off last time wasn't because of the valuation, but just because of all of the money that they were pumping into the world monetary markets, right? So we see a situation where they could bounce here, but I'm not actually sure that they're going to. And then at the same time, I see a situation where the cryptocurrency market is, one, probably going to get regulated, which is going to hurt a lot of coins. And two, a situation where there's probably more dominoes to fall, right? Like you've got like a systemic risk in the cryptocurrency ecosystem right now, and they're basically keeping things afloat by not letting their customers take their money out. So to me, trying to make any play based on the theory that like Bitcoin is eventually going to hold 20K is like that's not a bet that I'm going to make. You know what I mean? What does this mining talk mean on crypto? I thought it was... No, what I'm talking about isn't about mining. It has to do with blockchain activity. So there's kind of a few sides to this, right? Is that the coin is worth something because you can make transactions with it, right? But nobody is buying it because of that. Cryptocurrencies, or Bitcoin in particular, is not used as a medium of transaction anymore. So that doesn't necessarily control it, right? But they do have to use the blockchain to some extent. You're going to move things between exchanges and all of this sort of thing, right? So there is like a ratio between like the velocity of money on the blockchain and the price that can kind of give you a valuation that in the past has shown bounces in this location. But that last bounce that we had at this location, it was also an area that was like a relatively high valuation, right? I have a problem in volume profile and Jigsaw is not showing at all. What data provider are you using, Rhythmic or CQG? and has a restart of the application or of the data connection is likely to solve the issue. Assuming that you actually have the volume profile column, turned on in that. Okay, so Rhythmic, yeah. So with Rhythmic, there's this whole thing where they have to request the bars. So you might have run into some bizarre situation where when it made that request, it didn't go through, it got dropped or something. So if you reconnect to your data provider, like you disconnect and reconnect, it's likely that it will try and rebuild the volume profile. That's what I would try first. Blockchain came into the picture later on just to make the whole thing. What are you talking about? I'm reading back through. I lost my job. What can I do to make money online? Learn to code. I'm not sure what live action was trying to say here. I mean, there's mining, but that's not what we were talking about. So I don't know what he's referring to. Cool. Nor what FTH is saying there. Oh, look at that. So we were getting a little bit of buying. Actually enough of it there that it kind of made me feel like jumping on. But in terms of net contracts involved, it was not actually that much. And in the end, it's kind of fizzled out and is coming back down to the bottom end of that range. So this is still something. Now the spread has come into something a little bit more reasonable, and I might be able to get some fills on the limit in some instances, but I'm still kind of like, it's not giving me a clear enough trend for me to want to take a trade. I don't have enough predictive edge in what sign the order flow is going to be here in the next 15 minutes to be taking a trade off of it. Mining what? Gold? No. When you're mining cryptocurrency, what you're doing is you take the last block and then you take all of the transactions that are going to be included in that block and you kind of hash them together. And then you have to generate a number that will hash with that block that you just formed, which is the last block plus the transactions, right? It forms a new block. And then you have to create a what do we say, a key that has the least number of zeros in it, as I believe. It's the least number of ones or the least number of zeros in it. And you have to have a certain number of zeros in it, which is the difficulty, in order for it to be considered a legitimate key, right? And so whoever figures out a suitable key first is the one that gets ownership of the block. They put it out, they submit it to everybody, and now everybody goes, okay, that's the block. We move on to the next problem, right? That's how it works. So that's what mining in cryptocurrencies are. Okay. And all of these people, they go out and they get all of there's all this hardware that is being built specifically for Bitcoin mining. And they set up these huge operations in these buildings with huge airflow infrastructure to mine as much cryptocurrency as they can. And that's what mining is in cryptos. Mining customers like tulips, I guess. I guess it would be like growing lots of tulips. You know that they still, like the whole tulip thing is really interesting because like tulips are still like a thing in the Netherlands. anyways, well, man, the 30 year is kind of like at the low of the regular session, at least. So, actually seeing some steepening. I guess I was saying, earlier I was saying they were getting flattening. I think I was making a misread. Like overall for this session, it was flattening, but that move seems to have been a steepener. I'm experienced in trading futures, forex, and options, but I've never traded anything with bonds. You have a recommendation for a good place to learn the basics? Well, okay, so when you say bonds, are you talking about the bond futures like what I'm doing, or are you talking about real bonds? Right? So if you want to do real bonds, I do have a book. I forget the name of it. I have a book though about bonds that is like really, I have to tell you though that trading like real bonds is like a totally different. It's a little bit more like stocks. Like think about it as like stocks, but like you're analyzing the financial health of a company more so than anything. Where was it? I don't remember the name of the book that I chose. Oh no, wait, I would have it here on my phone because it was on Kindle. I bought it on Kindle. Okay, so I'm not even gonna bother looking that up because you're talking about futures. So if you're talking about futures, the first thing is I do have a video planned. Actually, I can walk you through a couple of the things that we were going to cover in that video right now. Shall we? This should be good. Then you guys can kind of help me here with making this document. So what did we have in here? Okay, what is a bond? How do all of the numbers work with them? What are the things that impact the interest rates? Liquidity, credit risk, the maturity, forward curves on the run yield, futures prices, delivery, Federal Reserve tools, currency relationships, corporate offerings, bond auctions, monthly. Okay. I'm not a fan of individual stocks, usually options or futures. Okay, so the first thing that we got to come in here and note is what is a bond, right? So a bond, bond is a type of security where an investor lends money, right? So, for instance, in our situation, the government needs to borrow money because they spend too much, right? So, to fund their operations, they have to borrow money from you, the public, right? So, what the government does to facilitate this lending is they issue a bond that the investors buy for a set value, right? And in government bonds, it's increments of 1,000, right? And then there's a couple of different ways that they get structured, but typically the bond includes regular interest payments that the issuer of the bond will pay the bondholder, which is called the coupon. And then there's a maturity date when the issuer must pay back the face value back to the bondholder. Okay. So say, for instance, you're buying a 10-year treasury note with a face value of 100,000 because that's basically what we're doing here, right? And the annual interest rate is 2%. And I'm only putting 2% out there because 2% is supposed to be like the quote unquote neutral rate, right? Why is it 2%? Well, okay. Treasury coupon payments are twice a year, every 6 months, right? So if there's two of them a year and the yearly interest rate is 2%, then that means that each coupon payment is 1%. So it just makes the math all easy, right? So every 6 months, the government will pay you $1,000, and then at the end of it, the maturity, they pay you back the 100,000. Okay, that's how it works. Okay. And there's a bunch of different flavors of it. There's corporate bonds, municipal bonds, etc. But we're talking about treasuries, which are the bonds issued by the government. Okay. Now, the 30 years is the only one that we actually call a bond. Everything else is a note or a bill, right? So the 2, 3, 5, 7, and 10 years are called notes. The 30-year is called a bond. And then there's the shorter term security is called bills. But bills are a little bit different because bills do not give you a coupon. Bills, you buy them at a discount, and then they when they pay you back at the end of it, they pay you back more. So like a bill, it's like you would buy it for $97,000, and then in 3 months they would pay you back $100,000 or whatever the interest rate is, right? Okay, that's a bill. But you don't worry about those, right? Okay, now. Fluctuations in interest rates can be super tiny, right? So we talk about it in terms of a basis point, which is 1/1000%, right? So a percent, you have a percent, 1%, 1.01. Okay, this thousandths, sorry, tenths, hundredths. Okay, it's 1/100th of a percent, right? Okay, that is 1 basis point. Okay, what we trade here in yields is 1/10 of a basis point. So we're doing thousandths, right? That's what we do here in yields. Okay, so 1 basis point is 1/100th of a percent. Okay, so the way that we have things set up here is that 1/10 of a basis point is $1. Basis point is worth $10 in the micro treasury yield futures. Okay. So that's how you kind of get the pricing of it. Now, what you see up here in the treasuries is price. These are yields. This is price. Price and yields are inversely proportional, right? So this is like how much the bond is actually worth. So they're basically, when they say 114, what they're really saying is they're saying you have a bond that is worth 114,000 plus 27.5 30 seconds. Okay, times 100,000, or essentially, right? Or sorry, times 1. That would be 1,000 would be, right? Okay, that's how much it's worth. Okay, so what you'll often see, you might see decimal approximations, but just note, right, when we get to the way that it gets priced is it's, look at the ZB, start over here at ZB, right? It's priced in 30 seconds. So we go 31 and then back to 0, right? 1, 2, 3, 4, 5, 31, 0, right? Because it's divided by 30 seconds, right? So 16 is half a point, right? 132. So if we were to go to 132.16, that would be half of a point, and then 133. Okay. The 10-year is half of that. The 10-year is half of that. So the 10-year, you're going to go 31 half, and then back to 0. Okay. And the 5-year is half of that. So in the 5-year, you're going to go 22 quarter, 22 half, 22 3/4, 23. Okay. And that's how the prices work. Okay. But of course, these are futures. So the actual price that it's at doesn't really mean too much. Really, the yield that it is at seems is more sensible, right? Like if you're looking for a level, like spitballing a level that at which, you know, there might be supply and demand or whatever, usually comes in at numbers related to the yield, right? Like when the yield, you notice that we're having a hard time getting to 3.5% interest rate in the 10-year, right? Okay. But over here, just note, because investors like even numbers, right? When you come over here into the S&P 500, like where the options are at, 3,700. So 3,700 is going to be a key point, right? People are going to be paying attention to that. You're more likely to see somebody put a big order at 3710, for instance, right? Because they're an even number. So what are the even numbers in the treasuries? They're going to be 0, 0. They're going to be 16. And then there's going to be quarters of that. So like 8 and 24. or sorry, 12 and 24. Okay. So those are kind of the even numbers. Okay. Now, remember, the key thing that changes is the interest rate, right? Because the government, will come out and they'll sell you a bond, and it's a certain amount, but then after they sell it, the interest rate will change, right? And so because the interest rate changes, the value of the bond that you hold kind of changes too, right? Like, why would you, like, if you went and you bought the bond for 2% and now interest rates are 3%, why would somebody want to come and buy your bond that only yields 2%? They're going to want to get the one that yields 3%. So what do? Well, for you to sell your bond, you're going to have to sell it for less, right? And that's why yields and prices are inversely proportional to each other, right? So really what we want to understand is what causes interest rates to change, right? So there's a few components that make up interest rate prices. And the first one is inflation, right? Because an investor is not going to invest in something if it doesn't make up for inflation, right? Because then it's not really an investment. They're actually losing money, okay? So Federal Reserve has a symmetric inflation target of 2% because, again, makes the math easy, right? Now, typically interest rates reflect more than just what it takes to make up for inflation, okay? And we've referred to this other component as real interest rates, okay? So I can take the interest rate and I can subtract the current inflation, and the number that I get after that is the real interest rate, essentially. And the real interest rate is basically means how much demand is there for capital in the marketplace, right? So in the regime that we're trading in right now, real interest rates have been negative because the Federal Reserve hasn't risen interest rates very much, right? So what does that mean? That means that there is not that much demand for capital in the marketplace, or rather that the supply of capital in the marketplace relative to the demand is really high. Anybody that needs money, they're able to get it, right? Now, when you tighten monetary conditions, what does that mean? That means that people are going to have to fight for that capital more, and that means that they're going to have to provide higher interest rates, right? Or higher real interest rates, okay? So, and then the real interest rates component, there's inflation, there's real interest rates. The real interest rates component is basically how much competition is there for capital in the marketplace, right? And then the last component is credit risk, okay? So how likely or what is the risk that the company or organization that you are lending to will not pay you back, okay? And in treasuries, this component is essentially zero, okay? Because the Federal Reserve can print money. So there's, like, in theory, there's no risk that the federal government won't be able to pay back your bond, right? Now with corporations is different, right? And so there's, in a corporate bond, there's going to be an element that is going to be the possibility that they're going to pay you back, okay? Okay, so now that you have that kind of that framework in place, right? Now you can kind of see how the Federal Reserve is able to use its policy tools to affect monetary policy, essentially, right? So if I want to have interest rates higher, or rather, I think that there's too much capital in the market. It's too easy to get money to go and fund your operations, right? And that's leading to inflation. Then all they have to do is raise interest rates, essentially, and that will create more competition for the capital in the marketplace. Right? Makes sense? Okay. Now, another component that you're going to have to factor into the prices here is liquidity. Okay. So you'll notice here in the micro 10-year, okay, that the spread is about 5 ticks, which isn't very good but that's just the micro treasuries. They're still a very new and immature instrument. When you go into the 5-year, it's like way, way bigger than that. Like, look at that. Right now, you're paying like 20, you're basically paying 2 basis points to be able to market order in the 5-year. Wow. Right? So what's with that? Well, essentially there's more liquidity in the 10-year, right? And that's going to affect the prices that you get, right? Essentially, there are some organizations that they're going to come in and they're going to want to buy or sell treasuries, and they're going to prefer to do it with a certain part of the yield, right? 2, 5, 10, 30, etc., etc. And so that is going to lead to aberrations in the yield curve. So now we get to talk about the yield curve. You see, I'm a little, so this is where I'm a little disjointed. I think I need to work on my outline here a little bit, right? So duration is another component of how much the interest rate is. So essentially, if I'm going to loan money to somebody for 2 years, right, I'm not going to ask for as much money as if I'm going to loan money to them for 30 years, right? 30 years, there's a lot more risk to me in loaning money out for 30 years because a whole lot of inflation could happen in 30 years, right? So I'm going to ask for a higher interest rate, okay? So the duration overall tends to create a higher interest rate, okay? But there's also liquidity demands and there's expectations about how interest rates are going to change in the future. And that can create aberrations in this yield curve, right? So right now, because interest rates overall are very, very low, and investors' expectations are that interest rates are going to stay very low for a very long time, the yield curve is very flat. So there's a little bit of a curve here at the beginning, and then it's just kind of like that. Like right now, we're actually inverted, essentially. You're getting less yields for a 10-year than you are a 5. You actually make more yield if you're doing a 5-year, or even not quite a 2-year, but for a 5-year, but then a 10-year, which is kind of like, what? Oil dumping like a rock. It's kind of been both sides here this morning. Okay. But there's also liquidity risk. So that's why there tends to be a little bump in the yield curve at the 10-year, because the 10-year is so popular. There tends to be like a little bump. All right. So these are all things that could affect demand for treasuries, right? How am I connecting that through? So I need to make a little bit bigger deal of like, how are these things that affect the supply and demand for treasuries? Okay. But now we got to talk about supply, right? How did the treasuries come out onto the markets? They do auctions, right? So at treasurydirect.gov, they come out and they say, we're going to auction off X billion dollars worth of US treasuries. And then there's all of these dealers and stuff that come in and they buy them in a competitive auction. Okay. So that's how the treasuries come out to the market. So that's supply. Now there's also alternative, competing investments here, right? So for us in the treasury market, our competition is going to be other countries and corporate bonds, right? So if somebody is offering a bunch of corporate bonds on the market, that's going to have an effect on us because that's kind of like supply coming out in a competing asset, essentially, right? Okay. So with all of that in mind, we kind of come down to here are the things that will affect flows in the treasuries. Okay. So a big one is going to be correlated assets, and the assets that are going to be correlated are going to be typically because they are like competitors to investments in treasuries. Okay. So that's going to be, bonds from other countries and currencies related to other countries. So the Japanese yen is the largest buyer of treasuries. So when the Japanese yen moves, that tends to have an impact on the treasuries and vice versa. Okay. Those are very highly correlated. Okay. Gold and silver are competitors. So they're kind of inversely correlated to the treasuries, positively correlated to yields. Gotcha. Okay. And then we've got the S&P 500 because stocks are like a competitor to investments in treasuries. Okay. So inversely, right? So when stocks are going down, then people tend to come over here and buy the treasuries to protect themselves. And vice versa. When stocks are going up, why would you want to be in the treasuries? You want to be in the stocks, you go over there. Okay. And then it's going to be supply. So auctions coming out. And then it's going to be things that could affect the interest rates, right? So the Federal Reserve is going to adjust interest rates based on what they're seeing in inflation and what they're seeing in the economy, right? Which makes treasuries very economically sensitive, right? So when I'm coming in here and I'm trading it every day, that's kind of the rundown that I'm going to be looking at. Is I'm going to be like, okay, so is there any supply coming onto the market today? Okay. Then we want to think into the seasonality and of the week and the time of year. So the seasonality in treasuries is there's a lot more activity at the beginning of the year, buying at the beginning of the year. Buying and selling. I guess this year it was selling, but there's more activity at the beginning of the year. There's more activity on Wednesdays. Okay, and there's a lot of weird activity on Friday. So we have a Thursday that tends to be a decent amount, but we are also in the part of the year that there's not as much activity in the treasuries, and it's kind of actually a little bit like kind of down. Okay. And then I'm going to be looking at what are some things that are affecting inflation right now, right? Well, I don't see anything specifically today that's affecting inflation, but we do have things that are affecting the economy. So we had the jobless claims print and we had the Philly Fed print. Those were both negative. Those are both bad for the economy. Those are deflationary pressures. So because of that, the treasuries buy the yields go down. Man, so you can see how when I started to get further into this, this needs a little bit of work before it becomes a video, right? Because I don't think that I have everything completely organized. I think that might be getting into a little bit of the weeds, and I might have lost John here at some point. But okay, so and then another big one is Fed speakers. What is the Federal Reserve itself saying about the current financial conditions and what they're going to do with interest rates? Okay, so that's essentially the forces that we're going to use to trade the treasuries here, right? And then from there, it comes down to the things that are relevant to all futures, right? Okay, sounds pretty good so far. Good. So I'm going to come in and I'm going to say, based on all of these factors, do I think future orders are going to be buying or selling? And if I have a situation where I'm very confident that the future orders are going to be very much skewed in a certain direction, I want to front run that order flow and get in it before that order flow comes. Okay. And they tend to make moves in 45-minute increments. So it's going to be like 8:30 Eastern time when the news comes out, then 45 minutes later, then 45 minutes later after that, then 45 minutes, right? And that's when you will tend to see moves originate. So do we have news, by the way, while I'm thinking about it? We don't have any 8 o'clock news, do we? No. We do have supply today. We have a 4-week bill auction. So that's something. But other than that, we don't have much else. But what we do have going on is all of the knockoff effects from yesterday. So that's all interesting because yesterday, what was it? Central banks have been hawkish. Okay, central banks have been hawkish. That has been pushing treasuries down. But then economic numbers have been bad, and that's been pushing treasuries up. So which side of this do I want to take? I don't know. You can see we've seen both ways today, right? We were up here, we came down pretty hard. They're moving back up again. It helps to know how the treasuries fit in with everything else I've been trading and supply. Yeah, it really is. Because once you understand what the treasuries are doing and how everything else is correlated to the treasury, what's going on really makes a lot more sense, right? If we come over here and something's happening that is lowering the interest rates in treasuries and making these buy up, that makes it easier for companies to borrow money. So that tends to be good for risk assets overall, but it's really good for growth companies like techs. And that's why in the easy money era, tech companies did really, really well, because the debt that they're carrying is a bigger portion of their balance sheet, right? Now we're into a era where interest rates are rising and tech companies have been slaughtered, except for Apple, because Apple, has so much freaking cash that it doesn't really matter. Now, another interesting thing about the treasuries that I should know is that the treasury pit session starts basically an hour before the S&P 500 comes, right? So the treasuries are kind of optimal to trade economic events simply because they're more active at that time compared to equities, right? And then because the equities, the stock market where the stocks themselves are actively trading doesn't get going for another hour after that. So that's one thing that kind of matters too. It's not uncommon on a jobs number, for instance, you have a big move in the treasuries and then another big move after the S&P 500 opens, and they react to that number essentially. To continue our discussion yesterday, GARS could run on hydrogen. Oh, yeah, sure. I have to say, one of the things, the point that I was trying to make with that conversation yesterday is that, like, no matter which way you go, you have to have a lot of copper. Like, all of those things involve copper. I don't know about hydrogen, but if you're using hydrogen to generate electricity, right? So then you are still going to have all of the issues with batteries and the materials that the batteries need and stuff, right? Yes, NQ is very sensitive to Fed rates. Yeah, NQ probably should be more sensitive to it than ES, for instance, right? Or the YM for sure, right? Because YM is more materials. Well, so I think I got the main things. I think that this first video is supposed to be more about what how treasuries work and how the Federal Reserve's policy tools work, right? I think that I should be having it split up. I think that it should be like, okay, here's bonds and here's the Fed's policy tools. I think that the second video should be flows, essentially. Supply and demand flows in the treasuries. And then I think that the last video should be about the curve, the yield curve. I also there's another thing that I haven't kind of covered. Okay, so there's a couple of other things that we should talk about. So, like, these treasuries, like new treasuries, are offered out there like every month, every other month. Okay, so there's a bunch of different like supposed 10 years, right? You could buy a bond that started with a 10-year, but it only has a month left, for instance. Okay. So when you're trading these treasuries, they basically, the way that they set it up, because you're actually delivering at the end of the contract, you're delivering a treasury to them if you hold the contract and all that, right? If you do delivery, you're giving them the actual treasury, right? So which treasury do you give them, right? Well, they have a list. They have a list of QSIPs that basically qualify, that are within a range, right? Okay. So the reality is that there's going to be one of those QSIPs that is going to be the cheapest for you to deliver if you were delivering. The cheapest to deliver, okay? So the price on the cheapest to deliver is what controls the treasury's price, okay? That is going to be different from the on the run yield. So the on the run yield would be the most recently auctioned off 10-year treasury, okay? So the 10-year treasury that they auctioned off last week is the on the run treasury, okay? The micro yields down here are linked to the on the yield, whereas this is cheapest to deliver. These ones up here, right? So if you get the interest rate based off here, is going to be slightly different from the interest rate based off here. Okay. So there's this whole, it comes back to yield curves, right? Is like, yeah, you think there's a yield curve, like there's a 2 and there's a 10 and there's a 30, and these are like the on the runs. But then there's the 10-year that was from last month, and there was the 10-year from the month before that, and there was the 10-year from the month before that, et cetera, et cetera, et cetera, et cetera, et cetera, right? And based on that, you can even start to go into the future. Is you can say, okay, so if I extrapolate 1 month into the future, what should the yield on that theoretical future yield be, right? And this is where we get into forwards. So there's all this math that you can use based on the curve and everything else to predict what the forwards are going to be, right? And there's the math between converting between this futures price and the price of the actual like thing that you're going to be delivering, right? So I don't have all of that math written down here, so I won't go through that, but there's all of that you want to think about. So there can be all these. So something that's interesting with forwards, something that you can trade. Actually, if you're going to trade like actual bonds, is you can trade the forwards, because the price that they say that the forward is going to be, it never ends up being that price, almost never, right? They're pricing in a bunch of risk that could happen in between now and then, right? So it's just like options. It's like realized volatility. It tends to be less than expected volatility. It's the same thing with forwards. And so that is a systemic inefficiency in the treasury market that you can try and take advantage of, although not directly here with the instruments that we're using. But the people that are trading it, these are the big companies that are trading it. These are the sorts of things that they're doing, is they're taking these trades over here based on this inefficiency in the forwards, and then they're hedging their exposure with the futures over here, right? So that's where some of the hedging comes from. Blah. I should work out the math of that one a little bit more, because I think we could go into that a lot. Oh man, there's so much. I think to organize all of this, I have a lot of work to go. I was hoping that you were going to come in and there was going to be things that I said that you guys were really confused about, but I didn't see a whole lot of that. I just saw a lot of, okay, well, this is a little disjointed, et cetera, et cetera. So work in progress, but we'll work on it. But I think I got kind of the important things for you to be able to come in and trade the 10-year, right? Because that's the great thing is that trading, especially for the micro yield futures, is a lot more simple, right? What are the things that I know right now that could affect the future flows in the treasury market? Is there news? What kind of headlines might I expect to see? And all I got to do is kind of wait for a situation where I really know and take a trade. Yeah, the correlation between equity and bonds can sometimes invert depending on the market context. No, correct. Because remember, there's different components of interest rates. Okay. And one of the components is inflation, right? One of the components is the real interest rates. And then another factor is going to be liquidity demand, right? So in a situation where inflation is happening, for instance, okay, we know that the treasuries are going to sell because the interest rates have to rise. There's inflation, interest rates have to rise. So that means that the treasuries themselves are going to sell. And what is that going to do to equity markets? That's not good for equity markets. So equity markets are also going to sell. If we're having, if we're in the depths of a recession and the Federal Reserve lowers interest rates, that's going to bring the treasuries up, and that's going to be good for companies. So the equities are going to move up too. So those are both situations where treasuries and equities are correlated, right? But then we also have a situations where, for instance, we have bad economic data comes out, right? So bad economic data coming out, that's bad for equities, of course, but that also means that the Federal Reserve is probably going to have to lower interest rates, and so treasuries will rise, and then you get inverse correlation, right? So essentially, the key difference, like the simple heuristic that I would be looking at is, are equities moving up or down based on the state of the economy, or based on what they think monetary policy is going to be, right? So when the markets are expecting monetary stimulus or the removal of monetary stimulus, then they will tend to move in positive correlation with treasury prices. Otherwise, they tend to be inversely correlated, right? When they're trading the actual economic data and not necessarily the expectation of monetary stimulus, when they're trading the actual economic data, then they tend to be inversely correlated, right? Did I walk through all of those scenarios correctly there? If we're having a really strong, what would be all of the different situations, right? Like I think there's essentially 4 of them, right? Right, they're both going up, they're both going down, in inverse in the both ways, right? So them both going up would be a situation where the Federal Reserve is lowering interest rates, and the equity markets like that, because that will be a boon to stock. Like what happened in mid-2020, right? Low interest rates, lots of stimulus. That means that the treasuries buy and the equities buy, okay? Then you get the situation like we've been having right now, where the Federal Reserve is expected to raise interest rates, and that is having a negative impact on stocks. And so they both go down. That's what we're having right now. Then you have situations that we might start to move into where the economy is really starting to get dire. Okay. So the S&P 500 is selling because the economy is dire. And so they come over here and they buy interest rates as a flight to safety bid. And it becomes a flight to safety bid because they anticipate that the Federal Reserve is going to lower interest rates, right? But the equity isn't moving up because they think that lower interest rates are going to happen. The equities are moving down because earnings are going to be bad, right? Company earnings are going to be bad. Stocks are going to be worth less, right? And then you have this other transition scenario that you have where we're in a recovery and equities are recovering. And so nobody wants to own bonds anymore. They start selling the bonds and they anticipate that the Federal Reserve will normalize interest rate policy, right? So when they are going to do which one, I understand as a new person can seem a little bizarre and contradictory, but I promise that when you start watching the flows and you do it from day to day, you're just going to know immediately, right? You can go, okay, that was really bad. That's going to cause the flight to safety bid in treasuries. Or they're talking about easy monetary policy again. That's buy all of the things. Or they're talking about tightening again. That's sell all the things. It was a complicated thing, though. What's Mohammed El Arain saying? And to think of the pushback some of us got when warning last year that absent policy corrections that sadly never materialized, the Fed, with its stubborn transitory inflation mindset, was embarking on a policy mistake that risked major economic, social, and institutional damage. Him responding to the Bloomberg Today tweet that the S&P 500 now implies an 85% chance of a U.S. recession amid fears of a Fed policy error, according to J.P. Morgan strategists. When I was a kid in the 80s, bonds were big. Yeah. Well, so here's the thing that's so interesting about that sort of thing, right? Is that you have an asset. When would you expect there to be interest in the asset? When the asset is really high or when the asset is really low, right? And of course, what everybody says, buy low, sell high. So at the bottom, there should be like lots of people looking to buy it, and that's when people should be interested in it, right? No, that's not the way that it works. Our situation seems very early 80s. Biden's economic approach seems very Carter. Yeah. So when bond yields were really high, there was a lot of interest in bonds, and so it was much more common of a thing for people to be talking about investing in bonds in the way that they talk about investing in stocks, like going into buying bonds for individual companies and municipalities and stuff like that. It was a much more common thing in the 80s, whereas today, when the bonds are really high, when the bond yields are really low, nobody cares. You know, I don't know what I was saying earlier. I was trying to apply something else that because it's the opposite, right? Really, right? For stocks, when is everybody interested in stocks? When they're super high, like in 2021. When they're super, super high and they're moving up big time, and that's when everybody's interested in stocks, right? But when bonds are moving up and are super, super high, the professional investors are buying them, but the regular person doesn't care. Kind of weird, right? But I think you might be right, John. I'm not so sure that it's going to actually happen this cycle, though. Like, what we seem to be getting right now is that the Federal Reserve is going to be really aggressive in raising rates for the next year. And then after that, it's going to subside and it's going to go back to low interest rates. So I don't think that you will necessarily in the next 4 years get the situation where bonds become the big thing. But if we think remember that Powell talked about this yesterday, actually. I apologize if I say something that's backwards. I'm a little ADHD. So, and the thing that's can be confusing about bonds, the thing that kind of I think makes bonds difficult is that when you're thinking about it in your mind, you're constantly flipping things, right? Because you got bonds and interest rates, and those are inversely proportional to each other. And bond prices, bond prices tend to be inverse to the S&P 500, but then rates are, anyways, right? there's that whole thing, and so sometimes I might myself get a little mixed up, right? But no, this situation where bond yields are really high. Oh yeah, okay. So where was I going? So Powell talked yesterday about like the generational level inflationary pressures that we've been facing, right? And the big pressures that we were facing previous to 2020 was aging demographics, improving technology that brings down prices, and competition from globalization. Those are all deflationary forces. And so, in that market environment, the Federal Reserve had to print a lot of money and keep interest rates low, essentially. Keep interest rates low in order to fight against those inflationary forces. So they're inflating the money supply to fight the deflationary forces. And it worked. I mean, worked really well, and it was a very positive environment for stocks, right? Now, when COVID came along, that kind of changed things, right? Because now we have supply chain disruptions, which is a very, very inflationary force, and deglobalization, which is an inflationary force, right? So when we go back to those three things that we had, right? Okay, the globalization factor is gone or has changed. But we still have the other two forces, right? The other two forces are technology making things cheaper. I think that's still probably going to be a thing, right? And aging demographics, right? So there is still this scenario where I think after supply chain disruptions are resolved, and who knows how long that takes, but once supply chain disruptions are resolved, we probably move back to a deflationary regime, although it probably won't be as deflationary as it was before, right? Jeffrey Gunlock noting that the 30-year just took out its 2018 high in yields. I gotta roll. Yeah, thanks. I gave a lot of information that was very disjointed and everything, but it's fun talking about it. Right? So that's where I go back to. Yeah, we're going to have raising interest rates, but I don't think that it's going to take it to the point where everybody starts talking about how to invest in bonds. Right? Let's see. Except for there are some reasons to get into inflation protected bonds, I guess. Well, it looks like the scenario that I was laying out for the S&P 500 is playing out according to predictions so far. We have pushed below 3,700, and now it's just kind of chilling down there. And it seems like the momentum for the time being has kind of subsided. So from there, we might see a reversal, but it may take a long time. So I don't think that a trade is very worthwhile over there in the ES at the moment. If I got a piece of positive news or something to make me really strongly want to buy ES, the current situation would make like a reversal like work way better, right? If it's a sell, there's probably a little bit of resistance below us before it would like really break. So, and in the treasuries, well, it was as I feared, I suppose you could say, because the thing that I was worried about was this economic news looks really bad, but I don't know if that like the flow from that subsides and then they turn hawkish again later, and that seems like what they did, although the hawkish side didn't make it too, I mean, they only made it back to basically open prices and they didn't push below that, like to below 114.20. So they kind of appear more like they're just balancing around 115. So I don't really have a good trade over there. So I think that for today, we just kind of chill and or talk about a little bit our little outline here, yeah? See, this part I have all written out. Main components that make up interest rate prices. I have some of these things that like I don't even remember where I was going with them anymore. See, like that part already done. That part I already wrote. Just gonna delete that part. Didn't know how I was planning on going from here. Typically, interest rates reflect more than just what is needed to compensate for inflation. This extra compensation beyond just inflation is referred to as real interest rates. The higher this component is, the more demand for capital there is in the marketplace. And the next component in interest rates is credit risk. This is the risk that an investor will lose money because the issuer cannot pay back its debt. So if the bonds belong to a company with a difficult financial future, bonds will typically yield more to compensate the investor for the increased risk. Treasuries are generally considered to have zero credit risk. The U.S. government has the highest credit rating in the world. They can print more money if they have to. So treasuries become the baseline that everything else gets valued against. Oh, I see. Treasuries set what the zero risk rate of return is. So the first and main tool is that the Federal Reserve can change the, what do we call it? The federal funds rate. This is the short-term rate that banks used for transactions between banks. That zero risk interest rate, essentially. So if the Federal Reserve raises the federal funds rate, then all other interest rates are going to move up to compensate. I don't agree with that at all, live action. Put a tick chart up and you'll see the trades all day long. Can't say you'll make money, but you'll have lots of action. Well, okay, so you can't say you can't make money. Yeah. No. Where do we come back to? If we want to be an informed trader, we have to predict order flow. So we have to have something that we believe is going to predict the order flow. And in today's action, we do not have that. And I totally called it correctly. Really, like, okay, so like when you come back and you look at this chart of the 10-year, right? Okay, so and of course, keep in mind that we started right here. This was the news, right? Right here is the news. Okay, so from here on out, right, we've kind of gone around on a range. So you could have tried trading this as a range, I suppose. Although, how do you know where the range is this time? I don't know. So the thing is when we started, when you had this, right? So what I thought might happen was what I thought was a scenario I was concerned about. Was we had this, and then it was going to go like this, right? And then we would have had this, right? So you kind of saw when it started to happen here, right? Just as soon as it started to happen, and I maybe would have tried to take the trade, it sputtered out, and the volume went the other way, right? So are you getting highly correlated order flow? No, you're not, right? It's a random order flow. Well, small trends, but relatively random order flow. Range all day. Why? Because you have competing market forces and it's unclear which one is dominant. So I think that for us, the informed trader, that not being involved was the right call. If we were to have made a trade, I think that the right one would have been front running that news, knowing that it was likely to be bad and that could have caused some buying in the treasuries. But you would have to take it pretty quickly. This move, coming back over here, this move right here, going into the market open with the decline, that was probably your best trend, but I don't see anything that would have told me that we could have done that other than this. The collapse of this might have been the case that I could have decided to go short right here, but I think that would have been it was a very risky, low probability trade that worked out, right? That you could have said, okay, it looks like the buyers aren't actually coming. They're failing here, so I want to take it the other way. You might have been able to make that trade, right? I'm predicting we might sell off. Do you mean in the ES or in the treasury or both? So I think that we've already kind of sold off in ES. I'm actually like, it's probably a really bad thing for me to say, but I think that at this point that the downside in ES is probably limited. I mean, it is negative. I don't necessarily want to fight the trend, but the options positioning suggests that there's going to be people hedging here that will be buying to hedge their trades, and so that's going to make it more difficult for the S&P 500 to continue dropping. In addition to bonds and so forth that appear to be having to buy. Are we down 4% in RTY? Let me go see. 3.9. Yeah, you're right. But what about ES? ES is almost down 3%. Nasdaq killer. It really is like the downside that we saw in the overnight action is really quite extreme. It was almost all blamed on the Swiss National Bank. Oh, that's what it is. CHF or SNK. Swiss National NK, I think means bank in Swiss. What's poppin'? Not much. Not much, unfortunately. They're all dropping, not popping. Pop-Tarts are popping. No, there's nothing popping in price. That's what I was saying, Nasdaq killer. Everything's selling. It's all selling. We're kind of, I'm not going to be like bottom feeding here or anything like that, but it should be in theory difficult for the S&P 500 to stay below 3,700. But we'll see. We'll see if they do it. It's already down 3% on some of these instruments, so I kind of suspect that you'll see some mean reversion here, but it doesn't look very good, does it? It's a little ugly in the market today. The liquidity of the treasuries really sucks. That's another big factor here, is that I really don't like trading it when it's gonna like just move 3 ticks out of nowhere, and I don't really have a really strong reason to think it's going somewhere. It's just kind of, if I thought that we should have really strong buying in here and it kind of does that stuff and it drops 3 ticks, like, hey, I'll take that one. But this situation does not look good to me for trading. Not the best conditions for trading. High employment, strange how easy Powell can bluff the market into buying the FOMC yesterday. Well, I wonder, NASDAQ killer, if like the thing is that, again, here in the S&P 500, with the way that the options are structured at the moment, and a pretty big options expiration this week, tomorrow, the whole market was kind of structured to be able to have a bump. In fact, what we've seen a lot of is that people are hedging themselves going into the FOMC, and so then when the Fed meeting happens, it tends to buy as they cover, the shorts take their profits, or they cover, or whatever the deal is. So I'm kind of wondering if the market was just kind of like structurally set up to buy anyways, and so all they really needed was just one headline to kind of grab onto to kind of get it started, right? Because the scenario that I still see happening, like, so today I expect that we will probably close above 3,700. I don't know how far down they'll go, but I'm not going to take that much risk on my current account. But if I, had a much larger account and I wanted to take on some risk here, I think that would be a risk worth taking, is buying ES here, and on the premise that it's going to get back above 3,700 before the end of the day. And we could continue to see chop in that area tomorrow, with the S&P 500 closing somewhere between 3,700 and 3,900, but probably closer to the 3,700 side. Then next week, after the options expire, at least on Monday, if not Tuesday, Wednesday, to see some more buying come in, as we see all of those hedges unclench, and there's going to be a little bit of chasing, because there are funds that have a lot of money that they're going to have to put to work in the market before the end of the month. So I think that you'll see that. But then after that, then it really is kind of like, all right, something, the economy doesn't look good. So then after that, then maybe the S&P 500 starts to make its move, and we look at if they're going to go and make a move to 3,400, right? That's the scenario that I see playing out over the next week. But we'll see. I'm looking out so far into the future that, the probability of me being right on all of that, it's super difficult to make that level of a prediction. Like, we're in an unusual situation where I can make that big of a call anyways. So I think that we have to put it as a grain of salt. I don't think that I could go and place a big trade on all of that happening, but I might be able to find some scalps here and there that work along with the premise, right? I could make a couple of scalps along the way that work with the premise. So we'll see what happens. Well, I wouldn't say that it's so much that they took profits. It's that it's structured for options market makers to buy, essentially, to hedge themselves. So the options makers are already kind of buying stocks to hedge themselves, and then you get something to pop it that makes the traders want to buy it, and so it pops extra hard. Then you add low liquidity conditions and all that. Oil sure is behaving interesting today, right? We had a period where it looked like that they were moving up and maybe reversing. They took pretty big hits at some point, and now they're reversing all of that. So it's just really, really volatile back and forth in the oil markets. Although the longer term trend, when you come back onto like our charts, is still down. Oh dear, my whole thing reset here. That is use my okay. So this is the rate. What's your premise today then? Well, in the treasuries, I don't really think we have one. I think that we have still some sell pressure in the treasuries from central bank hawkishness, especially with the Swiss National Bank coming out and doing a surprise interest rate hike. And just kind of like the sentiment in the treasuries is sell all the things, right? But then we have a bunch of really negative economic data that came out this morning. S&P 500 struggling a little bit, and so we've been seeing some buying flows, and it's been pretty interspersed in between each other. So I haven't taken a trade today yet, and based on the order flow that we've seen so far today, unless I get a really good news headline come out over the wire, probably I won't take a trade because we don't have a clear enough lead on what direction the order flow is going to be. So if I was trading equities, I think that I would be buying the dip here, but we shall see what it does. Mm-hmm. Who is the leader, S&P or ZN? I don't think, I'm not really seeing too strong of a correlation between them today. Wouldn't say. So I'm saying, like, it is a little curious to me. Oftentimes after a Federal Reserve meeting, you would expect them to be like, okay, now that we know what's going, now one side kind of takes the lead and we start to have somewhat of a move, right? But the markets today, a lot of volatility because there's not a lot of liquidity. The liquidity is all flighty because of all of the other insanity that we've had this week. But I'm not really seeing anything take leadership or anything. It's just kind of like meh. And if we were to have taken trades, the correct trades would have been reversion to the mean, right? So this is something we've never really been very good at, and I wish I could find some more research on. Maybe this is where being able to use spreads, and if we could find some trades in the spreads, that this might help. But the reversion to the mean trade is something that I've always had a hard time with. But if you were trading reversion to the mean and you really had a good signal, then I guess you probably would have done pretty well today, at least in the treasuries. Yesterday they were like yesterday, all of the assets, the charts look the same for almost every asset, don't they? That was a little crazy, wasn't it? It is kind of curious though, because the way that they ended up moving in the end was by all of the things, and I think that we have every reason to believe that what actually happened from the market after yesterday's move does not really reflect the fundamentals of the economy or what that particular meeting really meant. Like we're looking to see how do the markets move off of the meeting to see what the market thinks about this particular news event. That's kind of analysis that I think people are trying to do. And I think that this situation is such that we're not really getting a good read on that. I'm having this issue here this morning where my ability to talk is way ahead of my ability to like organize a coherent framework in my head. So I'm noticing that I'm able to talk without very many pauses. The words are coming to me and everything, but what it is that I want to say is a little bit behind. I guess that's because we're just in a very uncertain situation with not a whole lot of leadership at the moment. Leadership in terms of like market momentum. So anyways, we spent a lot of time before you got here, NASDAQ Killer. We spent a lot of time talking about the bond market in general. So I was kind of got into writing that a little bit. But I think I wrote that one little part that I wanted to put in there, so next thing would be balance sheet. When I talk about components of interest rates, because I talk about inflation, real interest rates, credit risk, but then maturity or duration or whatever, I forget what the proper term is within that context. Say there's some new highs in the treasuries. So that's interesting. Since the top of the hour, the order flow has been pretty strongly buy. I'm not quite sure where this inflection point came from. There is, well, and then there's kind of interesting because the dollar has kind of come up and back throughout all of this, so it appears to be an isolated move. Perhaps the flight to safety trade is in the end actually more powerful, because this move up in cumulative delta is a lot more consistent and has moved further than any of the other action today. So at the moment, it does look like that the day could end up being a bull day for treasuries, even though there was a lot of volatility in between. I wonder if a child unplugged my charger by my bed, because my phone did not charge. There we go. We did that way. I should probably buy another battery for my Sony while I'm thinking about it. Yeah, let's look it up. What battery do we have in the Sony A7 IV? Battery and charger guide, alpha shooters. Oh, I love that blog. Okay. You know what, guys? Don't ever get into photography, okay? It's just way too much fun to buy crap for your camera. I would recommend that you only purchase and use the official batteries. Okay. And you have to buy the charger separately. You know what, though? I don't think I actually need the charger part. I can charge it inside the camera with the USB, right? Some people buy every time J-Pow speaks, then they get wrecked the next day. That is how it's been going, isn't it, right? I saw this thing on Zero Hedge yesterday where they pointed out that for the last 3 or 4, I think it was, Federal Reserve meetings that the S&P 500 would buy after it, and maybe even continuing into the next week, but then immediately afterwards, that's when it would really start going down in reverse. So I think you might be right. Like again, I see a situation with the options where we could see some buying for the next week or so, but then after that, it could get ugly again. So we're kind of in one of those spots where you get the bear market rally that really sucks people in and tricks them. this move here higher in the treasuries though is very, very impressive. It's about a 15K net buy now that's been going for about 40 minutes or so, I would say. It is a good strong trend up. I'm not quite sure that I have enough to have taken that trade, nor am I sure if I have enough to try and take a trade right now. With the way that it's been behaving so far, the mean reversion trade has been working. So maybe you try and fade this at some point. Otherwise, well, okay. So if we come back to the volume profile really quick here. Okay. Well, if we were to be moving up, I could see 115.16 being a spot, but otherwise, so I suppose I could make the case that we could buy it here. But especially with this late into the session, I personally don't think that I should be taking a trade. So I think that I just get to sit here and feel the FOMO as this wild uptrend materializes, right? I don't know. Every time that I see the buy in the treasuries, I just think back to this. Like look at the way that it's been. Look at the treasury market here as of late. What if this is peak hawkishness? I don't really know for sure, but this could be a situation that could create that sort of a thing where it's right when the Federal Reserve gets really serious about inflation and really hawkish that it starts harming the economy. And that's as far as the inflation stops being a problem from here on out. And this is peak hawkishness. And ever after that, the Federal Reserve is like, well, there's economic weakness and we're not so concerned about inflation anymore. It could happen. You can buy pullbacks tomorrow if it stays up there. You're short ZF here. Live Action says, well, Live Action makes some good trades, I must say. So that speaks for something. But the question would be why. Don't tell me what the trade that you made was. Tell me why. It was this thing earlier. I think I chased Lucas off, right? Because with the whole LTQ thing. It's like, okay, that's okay if you think that LTQ is a thing, but why? Because I can't just go off of, okay, there's definitely an edge there because Lucas says that there is. So we got to figure out what it is, because it's probably much more likely to be the case that he thinks there's an edge in it and there actually isn't, you know? Ugh. So why, and that has to happen with every trade. So why are you taking the trade? What is the thing that makes you think that you will be able to predict the order flow here in this location? That's the thing that's useful to people, right? Or just like what your feeling about the market is. That's really valuable, I have to say, guys. Like, really, when I'm making TikToks, this always comes to my mind when I'm making TikToks, is that I see a lot of people, there's a lot of influencers out there, and the influencers that you tend to get on TikTok, they have their own way of kind of seeing things, right? So the big thing that all of the influencers read yesterday was, oh, the housing market is going to crash, right? Because Powell basically said, well, we need to get the housing market back into a better place. I think that they all kind of read that as, well, you probably shouldn't buy a house right now. I don't think that that's necessarily the right read. Like, I really don't think that housing prices are going to come back that much because, again, there just aren't any houses. So I don't think that you're going to see prices come back that much. But that wasn't the biggest takeaway that I got from the last meeting. The thing that was the most interesting to me was the whole discussion about the Fed's dual mandate and how that plays into inflation, headline inflation versus core inflation. Because the biggest problem that I continue to see here is that oil is really expensive, and it might be very difficult for the market to develop any kind of real recovery unless we have a change in the oil market. And you don't want to have a situation where, let's say that we have a recession, maybe this summer, and maybe, this year we're already in a recession, let's say. And then we start coming out of the recession, and that gets kneecapped again by high oil prices. That's a scenario. So that comment is more interesting to me. But in the end, I'm not sure if, well, I take that back, because the 75 basis point hike does matter, right? But I think that we're all looking for some read from what the markets did on Federal Reserve Day that will tell us where it's going in the future. And I just don't think we're getting that this time, are we? So I've been listening to News Squawk past 2 days because they gave me a free trial, and they talk a lot less than Financial Juice does, and sometimes it's a little eerie. They have a sound that plays regularly so that you know you're still connected, but it's still a little eerie to me. Maybe that's why I'm having a little bit easier time talking today, because I don't have Financial Juice in my ear talking. Hmm. Okay, so anyways, we were reading this about this. There's a charger. Ooh, there's a dual charger. Okay. Battery grip. Mm. Okay. So all we need to do is buy one of these. Probably from B&H. How much is it going to be? $78? Ah. All right. I don't remember my battery looking like that. What that thing is, I don't remember that. Well, I should probably do it. Oh, give me a minute, active. So you're saying you'll tell us after the fact, okay? I'm down. That's good. It's all good. It looks like so far since you took the trade that it might be working out for you. Just a little bit. I think you have it on the right side of the curve, right? Because if we're gonna sell here, the at least with the way that things have been going, and we've kind of been getting flattening, you're gonna see the 5-year sell off more probably, or at least you've seen flattening since the top. Look at that. Oh, look at that. So yesterday I said, Anthony, why are you running your stream an hour after my stream? I can't forward my viewers to you that way. So now today he's going live. Oh, maybe it's not on his channel. Let's see here. YouTube live. Yada yada benefits, blah blah blah. Oh, okay, so they're doing the Ninja Trader is doing their live stream at this very moment. So but I don't think that I can actually forward you guys to them. I would love to forward you guys to Ninja Trader, but I don't think it will let me. Where is it in here? They have like redirect, or actually maybe the right place to do it is down in here, stream settings, because it's like a new feature that they added. But like, I think that in order for me to redirect to you, the Ninja Trader has to add me as like an approved redirector personage. So like, it doesn't really work. No, I'll do it through here. I think it's under customization. Yep. Customization. Other channels. You don't have any redirect privileges. Ask creators to add you to their list in community settings. I will. Hold on. Let's see here. How would I ask them? How would I ask them? Ninja Trader has a pretty decently big channel now. They got up there real quick. Back testing index features. Well, that would be interesting, but are all of their videos just streams? Streams. Yeah, I think it is. Oh, no, this one is not. I'll email them. Trying to remember when the last time that they talked to me. Kind of missed what they were saying there. Faber on CNBC noting speculation that the Swiss National Bank is selling equities. Oh, I see. Okay. That could certainly harm us. Like, I'm not sure if that's enough to be like, we should be selling equities now or not, but equities are at their lows. So, how was it? Let me get back into that. How do I get into that? Customization, redirect, add other channels. All right, I'll send that to them. So you have to go find them on your own. I should probably do something with them, but actually, I'm not quite sure what's holding me back. I could probably put out another one. I should do some backtesting today. I think we should be able to do that. Okay, so Treasury's still kind of, well, I wouldn't say that they're like strongly breaking out quite yet, but that is new highs. They kind of like 115.16 has some volume at it too, so and the volume is coming in strongly. It's kind of an interesting setup because it seems to me, I could be wrong, but it seems to me that in the end, what has happened here is the flight to safety bid won out, right? I don't think that we necessarily had enough information to really be able to predict which side was going to win, but it does look like one side won. And going back to the whole theory about, well, I think that it will be difficult for the S&P 500 to stay below 3,700. So far, that is not playing out. Could be that the bid comes in much later in the day and that they get back to 3,700, right? But right now, they're selling pretty hard. Although, another thing that does seem to be going on here is that they are buying in the futures. The ES futures are moving opposite of the move. So maybe I'm right and the options are kind of creating a bid, but that it doesn't matter. The stocks are still selling off. Or maybe they're just, maybe the sell is just bigger. Yeah, NASDAQ now down 4.2%. Jeez. What does this look like on like a daily chart in the like ES? Oh, yeah, that looks really bad. That looks really, really bad. Like now all of a sudden it was like, okay, here was so there was kind of this bid going into the latter half of May, and then the beginning of June we had a couple of down days, and now this just kind of looks like like a flag. Oh, it is quite an extreme down bar as well. A pretty big down bar. Like when I look at it from there, here I'll show you the chart that I'm looking at. When I look at it like that, it's kind of like, how are they not headed for 3,400, right? So we're just seeing some stuff on Twitter about that they're working on arranging a call between Joe Biden and President Xi. I don't know if that matters or not, but well, it is an important headline. I mean, it's not going to move the markets here, but it is an important thing to note. Remember, it's going to be one of those things they will forget about completely, and then just one day it's happening. And like, oh wait, what? I forgot about that. Well, kind of a quiet session for us today, guys. It's okay though. We had some good chats talking about the treasuries. It was fun. Really need to organize my teaching materials around the treasuries a bit more, huh? One of the things is that like talking about like what a treasury is and all that sort of stuff is maybe a little bit too in the weeds to start with. Maybe what it should just be starting with is like, how are they priced, for instance, right? So, that point at which we were breaking out, and I was saying, well, it looks pretty strong. I think I probably could justify a little bit of a move in continuation here. If I had taken that trade when I mentioned that, I think that I would have gotten a little bit of adverse excursion, and I would have had to have waited a good 15-20 minutes. But we are getting some extension. Now the timing of it is curious because it hasn't been long enough, essentially. Maybe this is just kind of getting sucked back up into 16, and if there is another leg further up, maybe that comes later. But this trend up is become quite strong. You're early. No, you're not. How have you been doing? By the way, you didn't. You asked me a question, didn't you? Yeah, you asked me a question and I haven't looked yet. No, I don't see it. I swear you asked me a question in Discord. And when I come over and I look in Discord, I don't see the question anymore. It was about some other indicator that you saw somewhere. I was like, well, I don't know what other people's indicators do. I don't care. Gold back to 1834. So gold able to trim yesterday's losses. You send it to me again. I don't know why. I saw it on my phone when I was getting in the shower. I was like, oh, I'll worry about that after the stream. But now I just came into Discord just now and I didn't see it. Oh, there's an iceberg ahead of the 16. Okay. I haven't seen that one in a while. So it used to be the case that when there was a large order sitting out there, that you were really likely to see icebergs all around it, It would kind of become a mess around those prices. Lately, that hasn't necessarily been the case, but it's happening this time. Iceberg just before that price. There you go. Right through it. Wow. Quite forcefully, I might add. Strong bid behind it. Like it's all kind of saying we're taking this all the way back. I wonder. But where the yield closes at the end of the day could be incredibly important. If this continues, that is, if we continue to get the amount of trend that we've been getting and it turns into another one of those trend days, and let's say, how far much further could we go? Let's say we get to like 3.3. That would be a really big change from what we were seeing earlier in the week, wouldn't it? Oh, that's right. You were short. Oh, I would hope that you're already bailed, right? But the question again becomes, do we think that this is like a flight to safety bid sort of a thing? I think that's the best theory. But I'm gonna have to leave you with that. This is, this has happened a lot in the treasuries, frankly, is it's like chop turns to trend. Sell-off resumes. Wiping away Fed gains. Looks like it, yeah. Okay, guys. Well, I'm going to be really interested to see what the interest rate is tomorrow. But in the meantime, I'm going to move off to other things. So thank you guys for watching. If you're new here, make sure you subscribe and click that bell icon, because that will make it a lot easier for you to find my stream here every morning starting at 8:30 Eastern time. And check out all the links in the description too. I got, some discount coupons for Jigsaw. I'm hearing that there's some problems with those. I'll fix those. You can get the mug. The mug is nice as well. And the Financial Juice subscription. Man, if you do not have a news squawk, I highly, highly recommend you check out Financial Juice, the cheapest news squawk you can get. Totally worth it. So I will see you guys tomorrow. Stay profitable, friends, or at least don't blow it all.